your host, Shad Bogany, and you're watching Iconic TV. We are going to be here every Saturday morning and Sunday evening talking about what's happening in the real estate industry. You can also catch us on Tuesday on the radio at 96.9 or 1360 AM, where we're going to be discussing the latest information on the real estate industry. Today, we're going to be talking with my guest, Alyson Griffin with First Choice Loans, and we're going to be talking about the mortgage industry. Want to give you some ins and outs of what's going on. I would tell you Alyson is one of my favorite loan officers, and she knows what she's doing, so you might want to get a pen and a piece of paper out there and follow us tonight. Alyson, welcome to the Real Estate Corner.
Thank you, Shad. Thanks for having me.
You've been on several of my shows, but now we're on television. What do you think?
Oh, I think it's great.
Tell us what's going on with the mortgage business. What's going on? Let's start off that way.
Sure. Lots going on, as always. I think what most people see is the rising interest rates.
Okay.
A year ago, we were probably, if you had really good credit scores of over 740, your interest rate would be somewhere in the high threes. Today, their range is anywhere from 4 3/4 to 5.5% in the rate.
How important is the interest rate in regards to the consumer out there? Because and I think some of them have been spoiled because over the last 8 to 10 years, we've had a very low, abnormal interest rate. Do you think it's going to affect the consumer thinking, oh, it's going to go back down?
Oh, absolutely. And I hear that all the time. Oh, we're going to wait to purchase. And then a month goes by and the interest rate's a quarter higher. Housing prices goes up another $2,000 or $3,000. So really with rising interest rates, it really affects that buyer's purchasing power. So I've encouraged all my clients, I don't think it's going to go back down. Okay. Everything I'm reading, all the articles I'm reading, the economy's picking up, that there's more jobs in the economy, which is driving the rates up. And I think the Federal Reserve has another meeting to have them raised again. So I don't see it going down. I think when you look over the past 30 years, being in the 4s and 5s is really low.
Right, right. Well, you know, I used to say on the radio that, you know, that Abraham Lincoln didn't have a 3% interest rate or 4% interest rate. And I was looking at somebody's information that they bought a house in the 60s and their rate was 6%. Right. In the 60s. So we've been blessed to have the good rates right now. And so I truly believe that we've had a calm in the storm. We've had low interest rates and reasonably good prices, but now we're having affordability. And I think that's going to be the biggest issue coming up in the future. How do you feel about affordability?
Oh, I absolutely think you're right. I see it over the past 25 years of being a lender. I see more and more of my applicants' income going towards their house payment. With rising prices in Houston, we've, doubled in 4 years?
Right, right.
So where maybe 4 or 5 years ago, you could buy a brand new house for $120,000. That same house today is $240,000.
Exactly, exactly. We've seen since 2010 home prices go up 40% in Houston. I was looking at something for the radio show the other day, and we looked at the numbers and said that they're projecting 2.7% appreciation in the state of Texas. Now you've got to have at least $50,000 worth of income per year to be able to purchase a home. It's just changed so much. So now that we've gotten all of that out of the way, let's talk about the process itself, because even though we've got these incoming issues, it's still cheaper to own here than rent. So how do you start the home buying process?
Best way to start is to get pre-approved, not pre-qualified. The difference is if you get pre-qualified, they do everything by a verbal. So if you call a lending institution and you ask for a loan officer, they're just going to take your verbal information over the phone, which doesn't validate any of the income, any of the assets. Mm-hmm. And then they'll give you a letter. What's really, really important is you want that lender to review your income, your assets, and your credit to make sure everything's in line and that you truly are approved when you get that letter for $200,000, $250,000, $150,000, whatever that number is. More importantly is you want to know how much is it going to cost me per month. If I go purchase a $200,000, they should be able to give you an estimate. How much money is it going to be out of my pocket? Are there any special programs that can help me with my down payment or help me with getting tax rebates back through something like the MCC. What does it take to qualify for that? Now, the one advantage that we're seeing is the mortgage market industry is getting easier to get approved. In June of this year, the MI rates on conventional will be going down again, which is great. Even more important, get with a lender up front early in the process. Get your credit score up. If you have a credit score of 760 or higher, your mortgage insurance on that loan is half of what FHA is.
Wow.
That's today, and then hopefully it'll be even lower than that with the new rates coming out in June.
Well, Alyson, how does someone go about choosing the right mortgage company? Because in the past, I've seen people make major mistakes in the mortgage side, which is the most important side,
Right.
because they chose the wrong lender. How does someone go about choosing the right lender to work with?
Sure. Like anything else, when you choose to buy a home, pick a realtor, whether you're picking a lender, get comfortable with that person. Make sure they're answering your questions. Do your homework. You can go online. There's Freddie Mac and FHA that has questionnaires you can go through on what do I need to ask my lender for. What I always encourage, and I'm adamant about sending out, is I send out a fee worksheet. Before there's a loan process even started, if you're looking and you think you can afford $1,300, what does $1,300 a month buy you in Houston, Texas? So it's important you know what makes up that mortgage payment. Principal and interest, taxes, insurance, mortgage insurance, and then the HOA. So depending on what part of the city you're living in, that can vary greatly. For example, tax rates. We were talking earlier about Missouri City has a 2.2 tax rate, or if you go to some areas up north, it's 3.6.
Right, especially in some of the newer neighborhoods.
Right.
Where they're having, because you have the mud tax,
Right.
and you don't get your homestead exemption on the mud tax.
Correct.
Right, so you've got certain areas. I was at one neighborhood, it was 3.85. So
Correct.
if you look at a house at $200,000, you're looking at almost $7,000, $8,000 tax bill there, which makes a significant amount in your monthly payment.
Correct.
You know, a few years ago, Alyson, mortgage brokers, I could say, you could go to the cemetery and you see the tombstone, mortgage brokers. Now they've kind of come back. So
Yes.
explain the difference between mortgage brokers and mortgage bankers
Right.
and just a bank.
Right.
And what are you?
Sure. Well, I'm a mortgage banker. We're owned by a bank. So, but we are a wholly owned mortgage company, which means that we're closing our loans in our name, First Choice Loan Services. So we're advancing at the time you close the funds for that loan closing. So if you're purchasing and you borrowed $200,000, when you go to the title company and you sign all your loan documents, First Choice Loan Services is going to wire out from our account the $200,000. If you're a broker, you're going through someone like a First Choice. So if you're with Shad Mortgage Company, and Shad Mortgage Company says, Alyson, I want to broker from your company, well, then it's going to be First Choice Loan Services that's going to deliver the money, but Shad Mortgage Company would have helped you get there.
Right, so they're going to put the file together and go through, I guess, a couple of approval processes. Shad Bargaining Mortgage Company would approve it.
Right.
Then it goes over to you for the final approval.
Correct.
Okay.
Correct.
All right. So brokers are back in town. They're back in vogue, I guess you could say.
Yes, they are.
All right. And what about using a major bank? You know, I call them big box bankers. The big boxes where, and I won't call any names, but the major ones you see. They are in the business now, but I used to believe that if I got a approval letter from a big bank, it was good as gold. That is no longer the deal. I've seen them where they approve people. We go out and find a house and then turn around, Alyson, and we don't get the loan approved. Oh, we missed something.
Yeah.
What are you seeing out there with the big banks?
Well, what I see a lot is I would talk, if you're going to call one of the big banks, call and ask about their experience as a loan officer. And what I found is it's more of a training ground to get somebody in the business. As you know, Shad, big problem in mortgage banking is there's such a high barrier to entry now that licensing's here.
Right.
So it's very hard for someone who wants to get into the mortgage industry to get trained for the industry. So it's only on-the-job training. So what you see at some of these bigger institutions, and I don't want to make pick anybody's name.
Well, that's okay. You
Yeah.
notice I kind of skipped around. On the radio, I'm going to tell you. But here, I'm not going to do that.
So what I would tell you, if you're a consumer and you feel more comfortable with a big institution, ask them about their experience. Ask them how many loans they've closed. Ask them how long they've been in the business. Ask them if there's somebody you can call for a referral service. Because I think you're right. I think what's happened with the bigger institutions is they've hired all these people that might have 3 months experience. They mean well, they're trying to do their job right, they just don't have the experience.
Right, and it takes experience to be able to get a loan done, guys. It's really important. When I'm talking with first-time home buyers or even second-time or third-time home buyers, I tell them all the time, it is about the people you put on your team. If you want a successful transaction, put the right team together. And if you don't put the right team, it could be a horror story in that end. Now, there are some people today that are listening and they think that they need 20% to buy a house. Let's talk about the different down payment percentages that are available to people buying a house, because a lot of people out there are still saving, thinking that they need 20% to put down, and then once they get to 20%, the rules have changed.
Right.
And so now they got to go through another path. So tell us, some of our people who are watching us today on Iconic Television, what the down payments are required that are available now.
Sure. Conventional lending has really eased up. They've come back with their 3% down product. And again, once you have a better credit score, the mortgage insurance is really low on those products. I usually encourage people to have at least a 680 or higher to make it worth the while on the mortgage insurance on your payment. So at a bare minimum, you need to have 3% down on conventional, 3.5% down for FHA. And if you're a veteran, then it could be 100% financing. But keep in mind, that just means no money down. That doesn't include your closing costs, your prepaids, and other things you need to close on that home loan.
Now, and that's a great safe way. So explain to us, those who are watching us this morning, what the cost is involved in purchasing a home. We've talked about down payment. What else? What is closing costs and what is prepaids?
Sure. Prepaids, I always tell my customers, it's like a piggy bank. It's there to put taxes that you're going to owe at the end of the year for your property and your homeowner's insurance to make sure that when it comes renewed in a year's time, that there's enough money in your piggy bank to pay those bills. So you will choose your own homeowner's insurance, and then we'll escrow it for you. Okay, and as over the years, as it changes, they'll adjust your escrow account for that. Then as far as closing costs, general rule of thumb, they'll run anywhere from 2.5% to 3% of your loan amount. So those are going to include things like an appraisal for the property to make sure that when the bank goes and lends on it, it's actually worth what the market can bear. You'll have a survey. You've got to make sure that house sits on that land correctly to make sure there's no encroachments. You haven't gone into somebody else's yard. You're not in an airway easement. You'll have things like a title policy to ensure clear title, to make sure that you actually have title of that property, that nobody else is in front of you. You'll have things like recording. Nothing's legal in the state of Texas unless it's recorded in the courthouse. You'll have attorney's fees that will look over the loan documents to make sure the warranty deed, deed of trust, and the loan papers are filed correctly. So just to name a few.
So those are the costs that are involved in doing a home mortgage. And at this time, we're going to take a quick break and we'll come right back with you. You've been watching The Real Estate Corner with my guest, Alyson Griffin with First Loan Mortgage. Thinking about buying or selling, real estate can be a very complicated process. Finding one, how much can you afford? Get survey, put a home on the market, review the net sheets, taxes, advice on financing, homestead exemptions, advice on insurance, what kind of mortgage, inspections, considering offers, negotiations, submitting an offer, how good are the schools, down payment assistance, title insurance, home warranties, closing costs, final walkthrough. These are the pieces of the puzzle of home ownership. I'm the person who helps put it together and the glue that keeps it together. Give me a call, Shad Bogany. Welcome back to the Real Estate Corner. I'm your host, Shad Bogany. You're watching 1510, and we're here talking about the real estate industry. And my guest here in the studio with us is Alyson Griffin. She is with First Loan Mortgage. And Alyson, thank you for coming back for the second half of this show. Let's talk a little bit about the difference between FHA and conventional and the VA loans. What's the difference between the three loans? And if you are a buyer, which one would you choose or recommend?
Sure. Actually, the VA loan, hands down, is probably one of the best mortgages out there.
And veterans don't go out and use that loan. I find so many veterans who never use their VA loan. Why is that?
I hear a lot that they've gone to a lender and the lender said, well, it's just too difficult, too much paperwork. And that's so sad. My dad's retired military.
Okay.
So when I first got in the business in '93, I helped a lot of veterans get into home loans because it's a great mortgage for lots of reasons. First is no money down. So I don't have to have a down payment. Second is I don't have a monthly mortgage insurance or PMI on the loan that you're going to have on your FHA and conventional loans.
Okay.
So it gets me a better payment.
And a lower interest rate, right?
Right. Typically, FHA and VA loans have about the same interest rate.
Okay.
Conventional, depending on your credit score, usually is anywhere from about 1/8 to a 1/2 point higher in rate.
Okay. So other than the PMI, which I'm going to ask you to explain what that is, what's the difference between conventional and FHA, and which one would you determine would be best for your particular client? I know every situation is different.
Sure. Usually with conventional, if the buyer has a higher credit score, absolutely, they're much better conventional because they're going to get a better payment.
Okay.
It goes back to what I was talking about earlier about the mortgage insurance.
Right.
So when they've got FICO scores in the 700s, it's half of what FHA is.
Okay.
The other advantage with conventional is after a certain period of time, you can request from the lender to have the mortgage insurance removed. So even if you did have a higher mortgage insurance, but you knew you were going to be paying extra principal to the balance, and you got it to a 78% loan to value, at that point you can request from the servicer to have the MI removed. So that would save you money. On FHA, it can never be removed. Once you have your mortgage insurance on the FHA loan, it stays on the loan until it's paid off in full or you refinance.
All right. So regardless of whether or not you have a 20% down on FHA, you're still going to have that PMI. And so, Alyson, which loan should I use? When should I be an FHA buyer? What puts me in that FHA category? What's a life event that should have happened in my life for me to be FHA?
Well, a lot of times up to the customer.
Okay.
There's pros and cons for each one of them. And my job as a lender is to present both options to you.
Okay.
And to say, okay, if I can approve you under both scenarios, so what I do is I take your information in, I run you through my automated system, and provided I get my AU approval on both loans, I give you a fee worksheet that says, hey, which one do you want?
Right.
Here's what I see. If you go FHA, the 3.5% down, conventional 3% down, then it boils down to qualifying. Under FHA, there's more flexibility in accepting overtime income. Your debt to income ratios can go higher.
Okay.
I've got a little bit more flexibility on someone entering back in the workforce.
What about credit?
Credit, much more forgiving on the credit side.
On FHA?
On FHA.
Okay. So we've talked about private mortgage insurance, PMI, and we've mentioned it a few times. Explain to our viewers what PMI is.
Sure. Private mortgage insurance is to insure the investor, like First Choice Loan Services, in the event of a default. So the MI company is going to insure the top half of that loan. So if, Shad, I issue you a loan and you only put 3% down, and then you end up in the hospital and can't make your mortgage payment, and we end up foreclosing, then that MI company will cover the first top 20% of that loan.
Okay.
And then we're responsible for the bottom half.
Wow. Okay, so it's important to get that PMI. Now, keep in mind what we said earlier. If you put 20% down on FHA, it doesn't remove the PMI. Now, some people believe that if they put a large amount of money down, that they will have a lower note. Explain your thoughts on that, because when I've run the numbers, I don't know if it's worth all that money down. What's your thoughts?
Yeah, and I agree with you, Shad. Typically, once you put 10% down and you got a 90% loan to value, I ran one just yesterday on a $300,000 loan, and it was a difference of $110, but that buyer was going to have to come up with another $30,000 out of pocket. So when I ran the numbers and said, okay, if you put in $100, $125, or $150 every month into a bank account, it's going to take you close to 12, 13, 14 years to recoup that money. So you're better off hanging on that money, because in Texas, it's very difficult to get money out of a property. Yes, we've got cash outs and you can do a home equity line, but typically when you need the money is not when you've got the credit for it, not when you've got the job for it. It's you're in a crisis, I need to get it out of my property.
And banks tend to not loan money when you're in a crisis.
That's exactly right.
Okay. Let's talk about self-employed. I'm sure some of the viewers are sitting up there, they're entrepreneurs, and they want to be able to purchase a home. What are the rules of engagement for people who are self-employed to be able to get a mortgage?
Sure. As a general rule of thumb, you need to be self-employed for a minimum of 2 years and 2 years filed tax returns. So right now, if I was going to take your loan, you're self-employed as a realtor, I would need to make sure you had filed 2016 for a full 12 months, 2017 for a full 12 months, so that we could use that income and we're going to average it. So that if you made, let's say, $40,000 in 2016, but you made $100,000 in 2017, I can't use the $100,000. Okay. I have to average the two together to come up with the income for what you qualify for. However, there's rules and exceptions to everything. So there are situations where if you've been self-employed for at least 1 year with the filed tax return, then yeah, you can get a mortgage.
That has just recently changed, I'm assuming.
Yeah, well, we've got new investors in the marketplace. So yes, that's been in the past year or two. All
right, so they've come out of the woodworks because interest rates are rising and they can get a good return on their money, I'm assuming that.
Right, and a lot of those programs are going to require more down. So if you're self-employed and you've only had 1 year, well, then you're going to be looking at a minimum 20 to 25% down, and then typically a higher interest rate because to compensate for the risk, because they're only gauging you on 1 year of being self-employed.
Wow. Let's talk a little bit, before we leave self-employment, this is, you know, the accountants love to cut up self-employed income.
Yes.
And so what rule of thumb should self-employed people be very careful with when they're meeting with their accountant?
Great question. And I get the question all the time from the buyers. Ms. Griffin, what do I put on my income for my tax returns? I'm like, well, you put on your income what you made. I cannot tell you as a lender what to put on your tax returns. Keep in mind, as a lender, I'm going to go with your net income. I'm not going to go with your gross income. So Shad, if you sold $1 million worth of real estate and you only declared $100,000 in income, I'm going to go with the $100,000 because you wrote off advertising of $20,000, you wrote off supplies of $100,000. So all these deductions, I'm going to look at the bottom line.
Wow.
Now, what's going to be interesting is with the new tax laws and how the tax returns are going to look, because no longer is there going to be mileage from what I understand.
Right.
So there's not going to be a lot we can add back. So in the past, if you're a truck driver, I might be able to add back depreciation on your mileage. Maybe you had equipment you could depreciate that I could add back to your net profit. From what I understand from talking to my accountants, that no longer is going to be the case.
Wow. You know, Houston has just experienced the flooding, Harvey floods last year. And some people are trying to they didn't want to go back to their old house, but they would like to be able to go in and buy a new home. Are there any special programs for these flood victims out here?
Great question, Shad. Absolutely. 100% financing. So, under FHA 203H, the buyer has up to 1 year to get under contract and have the case number issued, which is how we order our appraisals. So we've got till in Harris County, September 15th of 2018 for that buyer to go under contract and make sure that case number got ordered so they can qualify for that 203H program.
Now, what about the house? Oh, well, better yet, is this program for renters and home or just homeowners?
Both.
Okay.
If you rented and you were displaced and the property was damaged to the point of reconstruction, then yes, you qualify. If you have a son or a daughter that lived with you and you own the property, but Shad, let's say your daughter lived with you too. Right. She's eligible so long as that property was damaged to a point that needed substantial reconstruction.
Well, I'm going to ask you the million-dollar question, Alyson. So let's just say I'm a homeowner. My property was damaged, and I don't want to move back there. So what do I do with my old mortgage?
Call your mortgage company first and foremost.
Okay.
And make sure, because what you don't want to do is be late on your mortgage.
So even though my house has been flooded, I still have to make those payments?
Yes, you do.
Okay. And so this 203H program, how do I qualify for both mortgages?
There are some guidance that if your current lender is going to be buying back your property through FEMA or through some other agency, then we can exclude the monthly payment. But there's just documentation we have to have in our file to say, yes, we know this house is going to be sold or taken back by FEMA.
Okay.
That will release you, and then you can go purchase the new property, not having had it fully resolved yet, but there's certain documentation I need in my file to cover that.
All right. So it's got to be some buyout or something.
Correct.
Dealing with what you're going to do with that mortgage. Okay. You know, earlier, Alyson, we talked a little bit about the down payment assistance type programs out there, and you threw out some things, MCC, down payment. Can you run through some of our viewers who are watching us can get an idea what, if they're a first-time home buyer, what programs are available to them to help them create wealth?
Sure, absolutely. One of the best programs is with the city or the county, which is what's called a true grant, meaning you don't have to repay that provided you live in the home, whether it's 5 years or 10 years in the property. But the catch to that is you have to be at 80% area median or less, and whether you're in the city limits of Houston or whether you're in the unincorporated areas of Harris County.
How much money are we talking about?
So for a family of one, Shad, I believe the income limits...
About 47?
Well, for a family of one, I think it's 42,000.
42, okay.
Right. It's right around there. And then you add about $4,000 per family member that goes into that house.
Wow, okay.
Yeah.
All right. And in regards to the MCC program, what is that program? Mortgage credit.
Fantastic program. It's an IRS program that allows the consumer to have a dollar-for-dollar rebate back on their taxes up to $2,000.
Okay. Now, I will tell you, out here in the marketplace right now, we've got a tight real estate market. It is a seller's market. It is not a buyer's market. So in the past, we've gone out and said, hey, let's ask the seller to give you some down payment assistance, pay some of your closing costs. They're not doing that anymore. And chances are, if they're doing it, the house has been on the market a long time and they've had trouble selling it. Typically right now, you've got, if you're a first-time home buyer, you're going to have to go through one of these particular programs that are out there. Now, you gave 80%. Are there any programs out there to do 110% of medium, 120? So we've gotten the money that you can get from the county or Houston, but what are some of the other programs that are available?
Sure. They have other grant programs or bond programs. So you have the TDHCA.
Okay.
You've got ZEF. And then you've got TSHAC. So under the TDHCA program, the buyer can qualify for up to 4% of the loan amount to help cover closing costs, down payment, or prepaids.
So if we had a $200,000 house, that's $8,000.
That is correct.
Okay.
All right. So with TSHAC, you can go up to 5%. Although with the volatile interest rate market right now, Shad, we've been having a hard time with that. So most of it's either 3% or 4%.
Okay. Guys, I want to thank Alyson Griffin for coming in. Alyson, thank you so much for bringing us some updates on what's happening in the mortgage industry. She's a great loan officer, guys. I just want you to know that. My name is Shad Bogany. I'm a broker associate with Better Homes and Gardens, Gary Green. You will be watching us next week here on the Real Estate Corner. See you next week. Thinking about buying or selling, real estate can be a very complicated process. Finding one, how much can you afford? Get survey, put a home on the market, review the net sheets, taxes, advice on financing, homestead exemptions, advice on insurance, what kind of mortgage, inspections, considering offers, negotiations, submitting an offer, how good are the schools, down payment assistance, title insurance, home warranties, closing costs, final walkthrough. These are the pieces of the puzzle of home ownership. I'm the person who helps put it together and the glue that keeps it together. Give me a call, Shad Bogany.